Welcome to Boni's Life. I am Boni, and today we are going to dissect the crypto market with surgical precision. Whether you are a short-term scalper hunting for the next 4-hour candle, a mid-term swing trader positioning for the next 2 weeks, or a long-term investor building generational wealth, this episode has something critical for you. The market right now is sending signals so loud that ignoring them would be frankly financially irresponsible. So grab your coffee, your notebook, and let us get into it. Before we dive in, if you are new here, welcome to the family. Hit that subscribe button, tap the bell icon, and drop a comment below telling me your current position in the market. Are you long, short, or sitting on the sidelines watching everyone else make money? No judgment here. But by the end of this episode, you will have a clear roadmap, regardless of your trading style. Now let me set the stage with the numbers that matter. As of today, March 4th, 2026, according to CoinGecko, the total cryptocurrency market capitalization stands at $2.55 trillion, up 5.6% in the last 24 hours. The 24-hour trading volume across all exchanges is $161 billion. Bitcoin is trading at $73,253, up 7.9% in 24 hours and 7.2% over the past week. Ethereum sits at $2,142, up 9.2%. Solana is at $91.42, up 8.1%. XRP is at $1.44, up 6.3%, and BNB is holding at $658, up 4.3%. These are not small moves, people. The market just woke up from a geopolitical nightmare and is stretching its legs. And now here is where it gets really interesting, and this is the part most analysts are not telling you. According to CoinGlass, total open interest across all crypto derivatives markets has surged to $106.72 billion, up 12.79%. That is a massive spike. When open interest rises this aggressively alongside price, it tells us that new money is entering the market, not just existing positions being reshuffled. The 24-hour liquidation figure is $530.48 million, with a staggering 81% of those liquidations being short positions. Let me repeat that. $431 million in short positions were liquidated in the last 24 hours alone. 129,349 traders got wrecked. The largest single liquidation was $12.62 million on Hyperliquid for a BTC USD position. Somebody had a very bad day, and I genuinely hope it was not any of you watching this. Let us talk about the Fear and Greed Index, because this number is screaming at us. The index currently sits at 10 out of 100, which is categorized as extreme fear. Yesterday it was 14, last week it was 11, last month it was 14. We have been stuck in extreme fear territory for weeks now. Now here is the thing that separates profitable traders from the crowd. Warren Buffett said it best: be fearful when others are greedy, and be greedy when others are fearful. When the Fear and Greed Index is at 10, historically, these are the zones where smart money accumulates. The last time we saw sustained extreme fear readings like this was during the FTX collapse. And what happened after that? Bitcoin went from $16,000 to nearly $100,000. I am not saying history will repeat exactly, but as Mark Twain supposedly said, history does not repeat itself, but it often rhymes. Now let me walk you through the Bitcoin dominance picture, because this is crucial for anyone holding altcoins. Bitcoin dominance, according to CoinGlass, is at 59.23% and rising. CoinGecko shows it at 57.4%. Either way, the trend is clear. Capital is rotating from altcoins into Bitcoin. 38% of altcoins are currently at or near their all-time lows, which is the deepest correction since the FTX collapse. The altcoin season index on CoinGlass reads 43, which is neutral territory but leaning toward Bitcoin season. If you are sitting on a bag of altcoins, wondering why they are bleeding while Bitcoin pumps, this is your answer. In times of geopolitical uncertainty and market stress, capital flows to the perceived safest asset in the crypto ecosystem, and that is Bitcoin. Let us now break down the global events that are shaping this market, because you cannot trade crypto in a vacuum. The biggest elephant in the room is the active US-Iran military conflict. We are 5 days into this, and it is not a drill. Iran's IRGC confirmed a missile strike on a US destroyer in the Indian Ocean. The Strait of Hormuz disruption risk is escalating, and JP Morgan estimates that a closure could remove 4.7 million barrels per day of oil supply by day 18. Iran has launched hundreds of missiles and over 1,000 drones, and Tehran reportedly can produce up to 10,000 drones monthly. This is not just a geopolitical headline. This directly impacts crypto through the inflation channel. Higher oil prices mean higher CPI readings, which means the Federal Reserve stays hawkish, which means risk assets, including crypto, face headwinds. Goldman Sachs CEO David Solomon warned that markets have not fully absorbed the impact of this conflict. Let that sink in. The second major event is Trump's tariff escalation. Treasury Secretary Scott Bessent confirmed on CNBC that the 15% global tariff rate will likely take effect this week, up from the current 10%. He indicated these tariffs could return to prior levels within 5 months, but in the short term, this is inflationary and negative for risk assets. Remember, the single largest liquidation event in crypto history was the $19.16 billion wipeout on October 10, 2025, triggered by the US tariff hike on China. Tariffs and crypto do not mix well in the short term. On the positive side, there are powerful institutional and regulatory tailwinds. Strategy Inc., formerly MicroStrategy, just acquired 3,015 Bitcoin at $68,700 per coin, bringing their total holdings to approximately 720,000 Bitcoin, worth around $49 billion. The CFTC has signaled that U.S. crypto perpetual futures approval is coming within weeks, and the Clarity Act is expected by mid-2026. Spot Bitcoin ETFs have seen 5 consecutive days of inflows totaling $1.45 billion. Indiana just signed a Bitcoin bill into law allowing crypto in retirement plans, and Kraken has gained access to the Federal Reserve's payment system. These are structural, long-term, bullish catalysts that are building the foundation for the next major leg up. Now let us get into the technical analysis, and I'm going to break this down for 3 different types of traders. If you are a short-term trader operating on the 1 hour to 4 hour time frame, here is what you need to know. Bitcoin has rebounded from the $63,000 wall low and is currently testing the $73,000 to $74,000 resistance zone. The Fibonacci 0.382 retracement level sits at $74,446. The RSI on the 4-hour chart is approaching overbought territory after this sharp bounce. The funding rate on Bitcoin is negative at minus 0.0066%, which means shorts are paying longs. This is actually bullish because it indicates the market is still positioned bearishly despite the price recovery, creating fuel for a short squeeze. The Binance Taker buy-sell ratio hit 1.18, the highest level of 2026, with taker buy volume exceeding $1 billion per hour multiple times. For short-term traders, the setup is a potential pullback to the $69,000 to $70,000 zone, which aligns with the Fibonacci 0.236 level at $68,916. If that level holds, it is a long entry with a target of 74,400 and a stop loss below 67,500. For mid-term swing traders operating on the daily to weekly time frame, the picture is more nuanced. Bitcoin is forming a morning star candlestick pattern on the daily chart, which is a high probability reversal signal when it appears at established support after a fear-driven sell-off. The 50-day simple moving average sits at approximately $76,333, and the 200-day SMA is at $83,034. Price is currently below both of these moving averages, which means the intermediate trend is still technically bearish. However, the structure is a falling channel recovery, and a confirmed daily close above 74,446 would signal the beginning of a trend reversal. For swing traders, the play is to wait for a daily close above the Fib 0.382 level, then enter long with a target of the 50-day SMA at 76,300 and an extended target at the Fib 0.5 level of 78,915. Your stop loss should be below the recent swing low at $63,000 or more conservatively below $67,000. For long-term investors and position traders operating on the weekly to monthly time frame, this is where the real opportunity lies. The weekly RSI at 53.18 is neutral with bullish divergence forming. The prior cycle high was $97,853 and the Fibonacci 1.618 extension target is $121,260. The macro setup is extraordinarily compelling. We have institutional accumulation from Strategy Inc. at 68,705 consecutive days of ETF inflows, regulatory clarity approaching with the Clarity Act, state-level Bitcoin adoption through retirement plans, and extreme fear readings that historically precede major rallies. The Bitcoin exchange balance has dropped to 2.47 million, down 8,530 coins, indicating coins are moving off exchanges into cold storage. This is textbook accumulation behavior. For long-term investors, dollar cost averaging in the $65,000 to $75,000 range, with a 12 to 18-month horizon targeting the Fib 1.618. Extension at $121,000 is the strategic play. Now let me address Ethereum specifically because it deserves its own analysis. ETH is at $2,142, up 9.2%, testing the critical $2,000 psychological level from above. 24-hour liquidations for ETH totaled $125.89 million, with the vast majority being shorts. The ETH-BTC ratio continues to decline, meaning Ethereum is underperforming Bitcoin. For short-term ETH traders, the $2,000 level is the line in the sand. A break below it opens the door to 1,800. A hold above it with increasing volume targets 2,300 to 2,500. For long-term ETH holders, the current prices represent deep value if you believe in the Ethereum ecosystem, but be aware that capital rotation favors Bitcoin in the current environment. Solana at $91 is defending the critical $80 to $85 support zone. A break below $80 would be technically devastating and could trigger a cascade to $65. A hold above $85 with a reclaim of $100 would signal strength. The 24-hour liquidation for SOL was 22.65 million, again predominantly shorts. For Solana traders, the risk-reward favors patience. Wait for either a confirmed breakdown below 80 for a short or a reclaim of $100 for a long. Let me now give you the economic calendar events that will move markets in the next 48 hours. Today, we have the US ISM Services PMI, which is the single most impactful scheduled release for crypto today. A miss below 52 would intensify recession fears and trigger risk-off selling. A bid above 54 could catalyze a move toward 75,000. We also have ADP non-farm employment, JOLTS job openings, and the Fed Beige Book today. On Friday, non-farm payrolls is the week's most market-moving event. A weak print reignites the risk-on crypto rally while a strong print caps upside. And from China, NPC policy announcements could signal fiscal stimulus, which would be bullish for risk assets globally. Now let us talk strategies, because analysis without actionable strategy is just entertainment. For short-term traders, my strategy recommendation is what I call the fear fade. When the fear and greed index is at 10 and liquidations are 80% shorts, the crowd is positioned wrong. Use the pullback to 69 to 70,000 as your entry zone. Set tight stop losses below 67,500. Take partial profits at 74,400 and let the rest ride with a trailing stop. Risk no more than 2% of your portfolio per trade. Use the funding rate as your edge. Negative funding means you get paid to be long. That is literally free money while you wait for your thesis to play out. For midterm swing traders, my strategy is the institutional shadow. Follow the smart money. Strategy Inc. is buying at 68,700. ETF inflows are 1.45 billion in 5 days. When institutions are accumulating during extreme fear, you want to be on the same side. Enter positions in the 68 to 72,000 range. Use the daily morning star pattern as your confirmation. Target the 50-day SMA at 76,300 for first take profit and the 200-day SMA at 83,000 for second take profit. Hold a core position for the potential move back to 90,000 plus. Use a wider stop loss at 62,000 to account for geopolitical volatility. For long-term investors, my strategy is the accumulation blueprint. This is a generational buying opportunity forming in front of our eyes. The confluence of extreme fear, institutional buying, regulatory clarity approaching, declining exchange balances, and a technical structure that mirrors previous cycle bottoms makes this a textbook accumulation zone. Dollar cost average weekly into Bitcoin between 65 and 75,000. Allocate 70% to Bitcoin, 20% to Ethereum, and 10% to high conviction altcoins like Solana. Do not use leverage. Store your coins in cold storage. Set a minimum holding period of 12 months. Your target is the Fibonacci 1.618 extension at $121,260 for Bitcoin, and potentially higher if the regulatory and institutional catalysts fully materialize. Let me leave you with this final thought. The market right now is a battlefield. We have a shooting war in the Middle East, tariff escalation from the White House, and an ocean of liquidated traders. But within chaos lies opportunity. The fear and greed index at 10 is not a reason to panic, it is a signal. The 5 consecutive days of ETF inflows are not random, they are institutional conviction. The negative funding rates are not bearish. They are fuel for the next short squeeze. The question is not whether the market will recover. The question is whether you will be positioned when it does. I want to hear from you. Drop a comment below with your current strategy. Are you accumulating, trading, or waiting? What is your Bitcoin price target for the end of 2026? Let us build this community together. If you found value in this analysis, smash that like button. Share this video with a fellow trader who needs to see these numbers, and subscribe to Boni's Life for weekly deep dive market analysis that cuts through the noise and gives you the edge. Until next time, trade smart, manage your risk, and remember, the market rewards patience and punishes emotion. This is Boni, and I will see you in the next one.